following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, welcome back. It is so great to hear that music again. It is time once again for Volatility Views. The show has been on a bit of a hiatus as we've retooled it and brought on some new partners to make the show even more exciting for you guys. I know we were able to do a couple of little shows there in the interim in the hiatus, but now the show is back full-time on the schedule, so you can look forward to it coming to your podcast provider of choice every Monday going forward. So we're very pleased to announce that Vol Views is officially back in the rotation. My name is, of course, Mark Longo from the OptionsInsider.com, as well as from this here Options Insider Radio Network. And it wouldn't be Vol Views if I was just doing it by myself. No, what fun would that be? I am joined by one returning character and one newcomer, who will get to each of those in a moment. We'll start with the returning character. Many of you may know him from his numerous appearances on the Option Block program, as well as from his many appearances on the previous incarnation of Volatility Views. He is none other than Mr. Mark Sebastian from Swan Wealth Advisors and Option Pit. Mark, welcome back to the show, sir.
Woo! 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 I'm excited. Nothing I like more than talking vol, and I'm excited about this iteration. I think it's going to be a lot of fun, and we're going to be able to kind of talk about, the same way we used to. It's going to be really fun and maybe with some added wrinkles, which I'm excited about. So this is just I couldn't be more excited for the new Vol Views.
And it's actually appropriate. Mark is joining us via telephone today from the heart of all things vol, deep there at the CBOE. We are holding a little seminar on vol as we speak.
That's correct. I'm teaching a class with Russell Rhoads, and we're talking about what's new in volatility for 2014. We're talking about the RVX, the VXST, the new iterations in VIX. We're talking about some stuff with V stocks, but a lot of the analysis on RVX and VXST has been specifically fun and informative for everybody to learn.
And of course, Russell Rhoads made an appearance on our most recent episode. Listeners can check that out in the archives. And also joining us for the first time on this relaunched iteration of Volatility Views, he is the major domo of all things option over there at Russell Investments, none other than Mr. Pat Fay. Pat, welcome to the program.
Thank you very much, Mark. Glad to be here.
Is that the official title on your card, major domo of all things options?
Not quite. I think our compliance guys might have a little issue with that.
I gave you a bump up.
I'll take it. Director Listed Derivatives for Russell Indexes. That's what they call me.
Well, Pat, since this is your first time on the program and indeed on our network, hard to believe you haven't made it on here in some way, shape, or form in the past 7 years. Yes, it's been 7 years, as I was just reminded so ruthlessly by LinkedIn today, a 7-year anniversary. But c'est la vie, it's been a while. Pat, why don't you go ahead and give our listeners a little bit of an overview of your recent history in the options and derivatives markets and how you found your way over to spearheading the options initiative over there at Russell.
Sure. Thanks, Mark. I joined Russell Indexes a little over a year ago to lead its listed derivatives business. And my responsibilities cover three main areas. I support our strategic partners and relationships, of which CBOE is a very major partnership for us. Just launching the RVX futures and options, which we'll talk about in a minute. I help to grow the trading volume of our Russell Index derivatives business. Meet with market makers, prop firms, retail firms, sell-side banks, all try raising the awareness of the Russell Index derivatives. And lastly, create new products and programs. And what do we have here? We have a new product, two new products, the Russell Volatility Futures and the Russell Volatility Options, and a new program here, Options Insiders Volatility Views. So that's me. I have a long history in the options business, and volatility products are near and dear to my heart. Back in 2004, I was very fortunate enough to lead the launch of the VIX futures product on the CBOE Futures Exchange, and have been very happy to watch it grow magnificently ever since, hoping we have the same traction for our Russell 2000 volatility products.
All right. Thank you for that, Pat. And, you mentioned the RVX is kind of the reason we're all getting back together here today to talk some interesting new products that are cooking in the realm of volatility, including what you guys recently launched, or should I really more accurately say relaunched, kind of goes along with the theme of this show, of this big relaunch theme today. You guys brought back an interesting volatility product. You brought back the RVX, like you just mentioned, the RVX futures, and probably more interesting for our audience, the RVX options. RVX, of course, being the Russell 2000 VIX, the VIX on the Russell 2000 small cap index. So why don't you go ahead and walk our listeners through. I gave them, a quick overview of the product, maybe go a little bit into more detail, and then I think more importantly, walk them through the rationale, the mindset behind bringing this product back in 2014.
Great, Mark. Sure will. The RVX futures were launched on November 18th. The options followed shortly thereafter on December 3rd. And Russell 2000 volatility futures and options are based on the RUT, or the Russell 2000 index options contracts. They infer volatility from the price of these index options. And as we know, RUT measures the small cap portion of the U.S. market. And that's significant because U.S. small cap stocks really are a window into the U.S. market. The vast majority of the revenues in the Russell 2000 companies is derived from U.S.-based sales, unlike the large cap stocks, which are more heavily influenced by international events. Therefore, interest rates, domestic activity, those things all affect the Russell 2000 stocks more prominently than they may the S&P 500, for instance, or the Russell 1000.
So is that the primary motivation for really kind of bringing the options back to the Russell, particularly the Russell VIX options? Was that something, looking for a product that gives you a little bit more, shall we say, domestic kick when these things happen, like the interest rate decisions and things like that?
Very much so. I would say there's really two reasons here for bringing the products back, and those are the giving folks a volatility tool for small cap stocks, small cap market. These for small cap stocks and the small cap market. But secondly, as we've just started to talk about here, the RVX moves in different ways than VIX does. And folks have shown a big interest in trading these two products against each other, correlation trades, if you will, relative value. And we can go into that a little bit further about how RVX acts differently than VIX and how that may provide trading opportunities for folks. One of the things you did mention, we wanted to talk about, was why now? Why bring it back now? And what's different now versus back in 2007-ish, 7 and 8, I think is when the products were originally launched and were listed for a brief period of time. VIX was still a rather nascent product. And, if we go back and look at what the volumes and open interest were in 2007, 2008, it was still 2006. I think VIX was around 4,000 contracts a day on some days. Folks were still getting a handle on volatility, how to trade it, how to model it. Now we see VIX, oh my gosh, think about it. Million contract days in the options. Futures are very active. There are ETNs, exchange tradable products, listed with the VIX as a basis. Folks have done the homework. They figured out how to trade volatility, and they have an appetite for it. So that, I think, is the biggest difference between now and the previous launch. Another minor difference I might point out is when the financial crisis hit in 2008 and volatility spiked, and you can all remember the levels, a very interesting thing happens. What happens? Volatility indices tend to come together. They almost act in unison, and their values may even come closely together. At that point, there's really no need for a correlation trade, and at that point, it doesn't matter what type of stocks you're holding. As they say, it's not a house on fire, it's the town's on fire, and everybody's looking at this as an extremely volatile situation. So that's what I would say the two biggest differences are, and the main one being folks now love volatility products.
You're right. Just the rapid explosion of this program is testament to that. The fact that it's continued to generate so much interest even over the summer while it was on hiatus. It's been people are just hungry for all things vol and indeed all things VIX these days. You can't get enough. The one thing we always get asked all the time at Options Insider is, what are some more volatility products that I could trade? So this certainly falls into this category. But I think maybe what makes it even more interesting to reintroduce this product now is that, the constant refrain we're hearing now, and we'll get into this a little more in the vol review, of course, is that, the vol is driving up. Where can I find other sources of vol? What's an interesting vol product to trade that has a little bit of juice to it? And people, I think, forget that Russell as a whole tends to be much more volatile than the S&P 500. You have all small cap stocks in there. Those are almost by definition more volatile than their bigger brothers. And so as a result, you have Russell, which trades at a dramatic premium to what VIX or S&P 500 vol would be on any given day. I think the range is probably somewhere historically between like 2 and 6 points. So you have a little bit of juice there in the Russell, which I think would be attractive to a lot of the listeners here looking for a product that actually has a little bit of premium, a little bit of a vol, a little bit of activity to go along with it.
Oh, absolutely, Mark. And that's one of the big things that folks will notice when they take a look at it. The RVX over VIX ratio has never been lower than 1 over its history. Hence, small cap implied volatility spread has always been positive. This spread difference between RVX and VIX in 2013 ranged from 10% to over 40% difference. So you're right. There's a big significant difference in the way these two move around.
Yeah, you know what's interesting on that though is that when the two indexes are lower, the spread tightens, but as a percentage of kind of the RVX, the spread is big. And then in like a 2008 scenario, the spread was averaged, I think, in 2008 about 5, and in 2013 it was the lowest of all the years that people have been tracking the RVX. It was a little over 2. So it's interesting when you have vols in the 40s and a spread of 5, and you've got vols in the a 5 and change, and you've got vols in the the 12s and the 15s respectively, or 14s, and a spread of barely 2 points. So there's actually I think one of the things that's going to quickly become apparent is some sort of there's an equal dollar trade to take advantage where one could theoretically get long vol and not have while not really having the same kind of downside exposure trading the two against each other. I think there's a lot of opportunity opened up with this product, and this is really the first vol contract that CBOE's listed that has seen any type of legs since the VIX contract. They've tried with gold, they've tried with EEM, a couple other things. The Russell is the only one that's really picked up some futures volume. I've got high hopes for that it could really be a big move, a big player in the futures market, much the way S&P and some of the other futures products and the Russell are good products that trade against each other on the CME and the ICE respectively.
Oh yeah, I couldn't agree more. If you look at it, the open interest in the options is already over 3,400, I believe, and the futures are over 500, and it's been pretty much trading for about a month here. And
that is really good. If you continue to have some open interest like this, one of these days you're going to see a Goldman Sachs or we'll see a Merrill come in and do 20,000 options, and then the product will officially be it'll be here to stay officially. And not that it's certainly here to stay, but it will take off the way everybody on this show seems to think it's going to take off. Let's just put it that way.
They'll do about 10 days worth of ADV in one trade, and then it'll be off.
And then the average daily volume will be up from then on. But
you're right, Pat. I'm looking at the numbers right now. You just crossed 3,400 contracts exactly today, or I should say yesterday. So very, very well done in just a month. To have this contract starting to take off like that. It's always nice to see some legs. And speaking of some legs, I think it's time to dive into the meat of the show. It's time to dive into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review. All of you who've been with us for a while know what the segment's about, but we know we have a lot of you guys tuning in for the first time. So this is, of course, the portion of the program where we typically break down the past week's worth of action in the volatility trading realm. But, of course, the show hasn't been on in a while, so that gives us a much broader purview in terms of the overall activity that we can dive into here on the show. And, Mark, it's been interesting because as I say that and as we're bringing back this show, the truth of it is from a vol perspective, there hasn't been a whole heck of a lot really coming into the marketplace here. We've been talking on some of our other programs on the network. Now we had towards the end of the year, people were looking forward to the Fed, and then that was kind of about it. All the juice kind of seemed to come out of the balloon going into Q1, at least until maybe March, when some of the new governmental debates will heat up again. But in between now and then, I mean, we're starting to see. We're recording this here on the 10th of January. We're starting off earnings season. That so far hasn't really done much to add any vol. This morning, actually, probably the biggest shocker of them all, we had non-farm payrolls this morning, and the entire week leading up to this, no one seemed to want to buy vol. Vol couldn't catch a bid, whether you're looking at S&P or anywhere else. Did that kind of surprise you as well, that even going into something like non-farms, there really was no sense of urgency to put on any hedging or any sort of vol bid whatsoever?
They crushed vol into this announcement. I mean, so we came in Monday and the VIX was at 14, the RVX was at something like 17, and they basically stepped in and just crushed vol all week. And now we've got the announcement out. It missed big. The S&P did nothing. As I look at it, the S&P 500 is down 30 cents. The Russell is up, about between 2 and 3 points. They're just destroying. They destroyed vol, and rightly so. Nothing happened. And it just goes to show you that when the market decides that something doesn't matter, and everybody steps in and dumps volatility in mass, they're probably correct. So this was a time where the straddle, yesterday's SPX straddle went out $12, and will settle today for $2 and somewhere around between $2 and $4. So not a bad sale.
Yeah, it just seems like collectively the entire marketplace has decided, you know what, we're just going to take the next few months off. Not at all. I mean, even in the days when we had supposedly aggressive sell-offs, granted a lot of those seemed to be tax-related in the beginning of the year there, and that certainly was borne out by the options order flow and the volatility flow because no one was buying it. Usually if you had a day of panic sell-off, people would be buying hedges, they'd be bidding up that vol, and yet vol ticked up incrementally. So really, there seems to be no sense of urgency anywhere in the marketplace across a broad spectrum of products to buy any sort of hedging. You think even, we joked on some of the option block shows this week, you think you'd see at least someone creep in late in the session yesterday on Thursday at 2:55 Central and pick up some hedges, some protection for the non-farms just in case. And you didn't even see that. So There really was just malaise, just blasé throughout the entire marketplace these days.
Nobody cared, and nobody cares. I think that you could see vol probably continue to get smoked through today, probably into Monday and Tuesday. And once we see that RVX get into the RVX get into the 16, 15 handle range, very rarely does it sit there for very long. And one of the interesting, the week of Christmas, a lot of people weren't paying attention to the fact that the Russell was really moving around while the S&P was doing nothing. I don't know if you guys caught that over there at Russell, but we had a couple of crazy days the week of Christmas that, and if you're watching the Dow or the S&P or the NASDAQ, you didn't see it. But if you're watching the Russell, it was going crazy.
Oh yes, and you might imagine we do watch it over here at Russell.
I would hope.
And we were pleasantly happy with and we get a little notoriety like that. That's always good for us.
Now, Pat, walk us through that a little bit because, like we said, you just launched this product a month ago. All the planning, all the work that goes into something like this, you launch it at the tail end of the year, coming into the new year, at a period where pretty much everyone else seems to have kind of written off vol, at least for the next couple of months. Talk to us about some of the challenges that poses for you guys. Here you are beating the drum, trying to get the word out about a new vol product when vol is trickling off even in the main thing like VIX. What kind of obstacles has that put out there for you guys?
Oh, boy. Reminds me of when we launched VIX Futures in 2004. Take a look at that chart. I think it hit 8 in 2004. It was a struggle, and this isn't quite the same environment, but it is a low vol environment, and the common response we get when we call folks up, stop in and see them is, yeah, man, can we just get a little vol? Can we just get a little vol? We'd all love it, but it gives, when things are quieter, it gives you time to talk to folks. Folks are more likely to pick up the phone, let you stop by if you're in town. So I think there's a yin and a yang to it. Yeah, you probably don't get as much juice out of it as you might say, a little order flow, things like that right at the launch. But it also gives you time to talk to folks. So while it's a challenge, there's a positive to it. The one thing I always know, volatility is mean reverting, as they say, and it always bounces around. So if you look at some of the prognostications for 2014, there's quite a few folks that are predicting bumpy rides. If you look at some of the Russell Investments research, we're looking at a market where there could be a few bounces, and I think this is where folks are going to start to take notice. And hopefully, as Mark from Options bit there and says, this is when a big bank will come in and plop down a 10,000 lot or 15,000 lot, and we'll be off to the races.
That being said, that puts that 3,400 contracts open interest in even more interesting light because it is a very dramatically challenging environment to get any sort of vol order flow these days. And so you guys have actually been getting some traction. And you said, you've been going around taking the time to go out and meet with and talk to all the prospective customers and liquidity providers. What are they telling you? What are some of the use cases that you see them? Because obviously you have some flow going on in here already. What are some of the use cases that they're actually putting this product to? Are they hedging or trying to trade correlation with VIX? Are they maybe coming in with a large IWM position and using this as a hedge to that? I'm looking here at the open interest. You have, even just in Jan, you have open interest, decent amounts, all the way up to 32 half strikes. So people are clearly using this, clearly in a similar scenario to VIX, focusing a lot on the upside. What are some of the use cases that they're putting to you when they're telling you they're trading this product?
Good point there that you noticed, and the Jans and the spread over the strikes. We've seen a lot of different trades go up. Small lots, 1 lot's here, 3 lots there, 3 lot spreads, and then you see 250 lots and 200 lot spreads. So it's got both a retail component, it looks like, and it has an institutional component. And in talking with proprietary trading firms, market making firms, there are folks that have big IWM positions and RUT options positions, and this is a way for them to manage their volatility a little finer grain than, say, using VIX. So I know there's been interest in that. There have been folks talking about doing that and indicated that they were looking closely at it. But relative value trades and correlation trades are always interesting. And if you look at some of the activity that occurs in V stocks now and has occurred in the last year, V stocks versus VIX, the comments that I hear is, wow, I like VStock versus VIX, but I think I like RVX versus VIX even a little bit better, or RVX versus VStocks even a little bit better. There's a little significant differences when you look at it. So I would say definitely some hedging activity, definitely some protection, but I also think some correlation plays and some directional opinions and volatility.
It's interesting you mentioned things like V-stocks and stuff like that, because that universe, that ever-expanding universe of ETPs has really been one of the big drivers of the success of the VIX platform overall. These new products continue to spring up, and they continue to drive volume back into the VIX futures and into the options as a hedging tool. So they've been just a huge part of the success story of that side of the fence. Is that something you're going to try to replicate over there at Russell? Obviously, we talked about IWM before. That's, of course, a big popular option product that will drive some vol into RVX. But, of course, continued explosion of ETPs around Russell vol could indeed ferret that, or I should say that continued explosion of Russell ETPs and Russell vol ETPs could continue to drive a heck of a lot of order flow your way as well. So has that been a big focus of yours in these early launch days, as well as trying to speak to that ETP community and get them interested in Russell vol?
Boy, you must have been reading my travel schedule. We definitely have been out there talking to the ETP exchange traded note providers, and there is interest. And it's interesting, the interest has not just come from them thinking about it themselves in light of VIX and the VXX product and that, but the customers asking, hey, this RVX is launching. When are we going to have an ETN on it? When can I trade it in my securities account as an ETN? So there's interest. What we need to do, though, is get the open interest to the level, get it trading in a decent amount of vega a day, so that folks are comfortable with it, the folks that would make the markets and list the products. And I think we will be there. So, yes, been actively pursuing that, and we hope to see it. I would say it's a mid to late 2014 product if all goes well.
I have to say, for me personally, it's nice to have another product to sink our teeth into here on Vol Views. We've talked about VIX so many times over the past 2+ years of this show now, coming up on 3 years. It's hard to believe. And, of course, we had the great stuff from the Volex guys, but those never really got enough traction in the marketplace to really discuss the volume going on behind them, even though they were very theoretically interesting. So having a new vol product that people can actually sink their teeth into and actually trade, and for us, in turn, to sink our teeth into here on the show and kind of carve up and discuss with some actual order flow behind it, that's intriguing for us. And, Mark, I don't know if you're thinking along the same lines I am, but whenever I think RVX is, of course, the correlation trades to VIX and all the stuff like that. But for me, I still look to IWM as really kind of a key driver, a key interesting source of hedging and other kinds of activity for this product going forward. Is that your thought as well? Do you think that IWM really, especially in the early days, is going to be the big driver? Because there's just so much open interest out there. It's got to start trickling in. Is that your take as well?
Yeah, I think RVX is going to be great against Russell traders, small cap funds. If any small cap fund or small cap manager or a cyclical manager or anybody that does small cap buy writing is going to be all over this index. And, again, I think that RVX, and I'm also excited about RVX versus VIX versus V stocks. And, I think having this as a listed product will also hopefully facilitate some interesting things in the over-the-counter market that maybe kind of the two feed on each other, producing some volume as well. And because there is a large over-the-counter IWM and Russell trade that goes up, and giving these guys an RVX product, I think, will be of value to them.
All right, and that is going to do it for our inaugural return to the Volatility Review. And now we're going to keep on rolling. It's hard to believe, but you guys kept writing in even though the show was on hiatus, so we got some great questions for you guys. We picked a few to kind of dive into today on our inaugural Volatility Voicemail segment.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the Volatility Voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, and welcome to this inaugural Volatility voicemail segment. This is, of course, a portion of the show where you guys get your chance to sound off and make your voices heard and let us know what you're thinking and what you're working on. And because we want to hear what you guys have to say so much, we've even reinstated our old voicemail line so you guys can dial in and we can actually hear your voices as opposed to reading your messages here on the air. So if you want to join future episodes of the Volatility voicemail segment, leave a message for us here on the show, just dial 773-669-4VOL. That's 4865, and you can leave your messages for us here on the show. And if they're interesting, we'll play them on the air. But we got some great comments and questions coming in from you guys. A lot of you writing in with the same theme. I kind of just picked one here for the beginning. A comment from Mr. Inc. coming in via Twitter. He just writes, at Options, it's great to see that Volatility Views is returning to the schedule. It's my favorite show. Can't wait to hear it again. Well, a lot of you guys wrote in with that same theme. We want to thank all of you guys for being so patient with us. A lot of you wrote in. We know you like this show. We're bringing it back. We worked as hard as we could to get it back as fast as we could, but now it's back. So Mr. Inc. and all the rest of you out there can rest easily. Every Monday, you'll have a fresh new Vol Views waiting for you. And we're looking forward to hearing what common questions you guys have for the show going forward. Speaking of questions, we got a good one here. This is actually right up your alley, Pat, so I think this is a good one for the relaunch of the show. This question comes from Joseph Hill, writing out of sunny Spokane, Washington, at least compared to the polar vortex Siberia we've had of late over here. He writes, great episode with Russell Rhoads from the CBOE. I hope Vol Views will be back on a more regular basis going forward. Well, again, that gets to what we were saying earlier. And, of course, the Russell Rhoads episode, that's the one we did on our little hiatus there, kind of an interim episode. Check that out, listeners, if you haven't already. You can find it in all the places you find your Vol Views episodes or on the website, theoptionsinsider.com. Just check out the archives. Joseph goes on to write, I also have a question about vol trading. I like the idea of VIX options, but I'm not heavily invested in S&P 500 stocks. I think something like NASDAQ VIX for my tech portfolio and maybe Russell VIX for my small cap. My question is, are these products identical to regular VIX options except for a different underlying, or do they have different calculation formulas, settlement dates, etc.? And then he says, any plans to launch a futures show? Joe, let me answer that last part first, and the answer is, yes, Joe, we are working on a future show as we speak, so that should be coming to a podcast provider near you very shortly. Stay tuned for that, but we still have to line all that up. But getting back to the first part of your question, this is something we've received a lot since RVX and other ones like the Gold VIX and others have launched. People write in a lot saying, hey, is this just kind of a VIX branding thing, or are these actually kind of the same fundamental contracts in terms of contract specs and settlement dates and all this kind of stuff? So, Pat, why don't you go ahead and walk our friend, Mr. Hill here from Spokane, through the specs for your contract and really how it lines up with the existing VIX stuff.
Thanks, Mark. And nice to hear from you, Mr. Hill from Spokane, Washington. I just got back from Seattle, Washington.
Yeah, it's actually your new neck of the woods, isn't it?
Yeah. I get out there a lot now. It's the mothership for Russell Investments. And we have a large staff and great folks out there. So the thing to remember about the Russell 2000 Volatility Index is that it's calculated identically to the VIX futures, VIX options, VIX index, except for one thing. It uses the Russell 2000 index options, or RUD options, as its underlying calculation input rather than the S&P 500. So other than the basket of stocks and the index that it's based off of, the calculation, settlement dates, market multipliers, or value per contract, all that's the same. So if you look at a VIX contract or an RVX futures contract, they're both going to be a $1,000 multiplier. They'll both move in similar fashions versus their underlyings. The options contracts are also the same. So that should give folks some comfort that this is a tried and true calculation method, settlement method, and things like that. And as far as using RVX for your small cap portfolio, as we talked about earlier, yes, it's more appropriate. It's a better measure and a better tool to use against your small cap portfolio. So there you go. I think I should take a look at it. Might give you some options.
Pun intended. Now, yeah, but you're right, Pat. This is kind of a question we get a lot, and people are just concerned for whatever reason that VIX just doesn't mean the same thing to each of these products. But you're right, it is the same methodology, same expiration structure, all that same kind of stuff, same settlement. So if you're familiar with it, if you've wrapped your head around it in the regular VIX product, then you can wrap your head around it in some of these other ones, like, of course, the RVX. So thanks for writing in, Mr. Hill out there in the neck of the woods of Russell. Maybe he's one of your coworkers in disguise, Pat.
Yeah, there you go.
All right, and last up here we have Sid S here. It looks like he wants to hide his last name, from Des Moines, Iowa. Probably not as scenic or sunny as out there on the Pacific Northwest. He writes, what's a good way to trade corn volatility? Do I have to do straddles on the big futures options, or is there something else? Maybe a corn VIX that offers a more direct approach. Thanks, Mr. Sid. All right, Sid, this interesting question. We touched on commodity vol on this show a lot in the past. And the truth is, kind of the direct approach you outline is still probably the best way. I know it's not ideal for a lot of you guys out there who don't want to bite off a big futures options contract or have to open up a futures account first. There's a few steps in there. A lot of brokers have made that process pretty easy. Now you click a couple of buttons in your brokerage tab, and now, bam, you have a futures account as well. So that process has gotten a lot easier. A lot of them all also merge the accounts into one single interface. So for all intents and purposes, from your perspective, you kind of have just one account. So that hurdle has at least been removed. And that still is pretty much one of the best and, the deepest and kind of the most liquid ways to really trade, corn vol directly. You don't have to be straddles. You can, of course, do all the other strategies you talked about on the show. You can do verticals. You can just do straight up long or short options. There's a vol component to all of those as well, obviously. You don't have to just bite off straddles if you don't want to. But, people have talked, there's, of course, the corn VIX itself. That's CIV. That's disseminated by kind of CBOE and the CME, a little joint product they have going on, or I should say a joint project. But that's kind of all it is right now. It's kind of just a project. It's not really a tradable product yet that you can sink your teeth into. So you can look at it, you can get a feel for it, you can get the quotes that have been disseminated out there for the corn vol to get a feel for what's going on out there. But unfortunately, you can't really trade it. And I don't know, maybe Mark, you have a different opinion, but I take the dim view of the corn ETF. That's corn, one of the bigger ones out there. That's ticker symbol CORN. But even that one, it's one of the larger ones, and still from an ADV perspective and everything else, it's not really lighting up the tape. It does about 500 contracts a day, so it's still pretty thin. Still, the markets out there are still pretty wide, so if you're going to be trading this guy, you're going to be paying a hefty premium to do so. So if you can manage it, my recommendation is definitely stick with the deep liquid stuff on the future side of the fence, because that's where you get the best bang for your buck. Mark, is that your take as well?
Yeah, I mean, the only positive on that corn ETN is they actually have done a pretty good job of managing the contango. So you don't have a lot of futures risk.
Well, that is a big part of it. That is a good thing.
They've done a really good job with. They're one of the few commodity groups that have actually figured it out.
So what do they do? Just to get, as an aside, what do they do so differently? Do they not rebalance every day, or what's the deal?
No, they don't rebalance every day. They hold a grouping of contracts that basically represents the entire curve pretty consistently. And so if the curve is moving around, corn's moving around. And it's not just going to die with the front month contract. They do a pretty good job.
That's huge. That's the kiss of death for so many of these products, is they just get destroyed by roll risk.
It's not a bad little product. But you're right. It doesn't do the volume. If you really want to trade corn and you've got corn exposure, the only way to do it is in the futures market. It's just the way it is. Sorry.
Yeah, I know. It's you kind of have to append that to the end of it. Sorry, because no one wants to really hear that, but that's still where the depth of the market is. But it's interesting to hear about the corn ETF and their structure, because that's the Achilles heel for all of these products, is they just get consumed by roll risk. So they can find a way to at least mitigate some of that. That makes it a little much better product.
They've done a pretty good job. You don't have the same roll risk with that product, and soybean as well. But neither of them have really taken off from a trading perspective. So in the option market, so that's just what I've seen.
All right, thank you for that, Mr. Sid, and for all you guys who wrote in. I know we didn't get a chance to get to all of your emails and tweets and Facebook messages. There's been a lot of them, as you can imagine, over the past few months while the show's been a hiatus, but we'll certainly get to more of them in the coming episodes. But now it's time to dive into our final segment, the Crystal Ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, welcome to our final segment, the Crystal Ball segment. As the name implies, this is where we take a little bit of a look into the future, into the coming trading week, and let you know what we expect, what we're looking for from the volatility trading activity that's going to go on. Maybe we'll mix it up a little bit. We'll start with you, Pat. I know it's been obviously early days still in RVX. It's kind of hard to sit here and prognosticate deeply or wildly about what's going to go on in the coming trading week. But maybe we can talk maybe a little bit more 10,000 foot when it comes to the RVX itself in terms of kind of some of the stuff you're expecting to see, some of the use cases you're expecting to see develop in the near term as this product starts to catch hold a little bit.
Thanks. One of the key things to remember for next week is that it is not an expiration week for VIX, RVX, and the volatility indexes. This is one of those months where the settlement day, the last day, and the contracts expire. That occurs after the normal listed options expiration. Therefore, we're going to have our settlement day on the 22nd, I believe, Wednesday, 22nd. What'll be interesting about next week is that you're only going to have one trading day that week, the following week on the 21st, Tuesday, because the 20th is a holiday. Therefore, will we see some roll activity? Will we see folks rolling out of their Jan positions and into Feb or March positions? That'll be an interesting thing to take a look at and to see what goes on there. And I think as we get out, sort of evangelize on the product and get folks more interested in it. Hopefully we'll see some Feb positions being put up next week, maybe new positions, not just roll positions, and as people start to track off on trading the Jan contracts. So that's where I think we might take a look.
Yeah, like I said before, you do have some interesting aggressive upside activity here in Jan. So if you can carry that out into Feb or maybe roll it, that'll be a good sign for the product as a whole. People are, like I said, trading all the way up to the 32 half strike in Jan and even up to the 30 strike in Feb. So they're clearly someone out there is perhaps expecting a little bit of a pop and vol in the near term. We'll have to dig into that open interest to see exactly what's going on out there. But it's also interesting to note, obviously, you're talking about, I hate to call it, I don't know, the big VIX, maybe you can call it the regular VIX, or whatever you want to call it. The use case out there is pretty well defined. People like to dive into that for either a hedge or a speculation. Most of that activity, consolidated on the upside there and the call wing. I think right now we see about a little over 2-to-1 calls to puts out there. So far, I know it's still early days, but so far the RVX seems to be shaking out a little bit more egalitarian, maybe, if you want to say, only about 1.5-to-1 calls to puts. So maybe there is a little bit different use case shaping up out there. Of course, still early days, kind of hard to read into the tea leaves, but I thought it was kind of an interesting little bit of a difference we're seeing emerging there.
Yeah, we noticed that too. That was very interesting. You're right. It's about a 2-to-1 on the calls versus the puts. So, I think I'm going to make a few calls come Monday and ping people, see what's going on. We'll see what they're thinking.
Sounds good. Then we can pick their brains collectively on the next episode. All right. And Mark, what are you watching for this coming week from the world of volatility?
I'll tell you, the RVX and the VIX and all that, they're going to be driven by a completely different VIX indicator, the VXTYN, the 10-year. And that is going to be what, in my opinion, ends up being the index that is the driver of the other two at some point in this year. If there's going to be something that screws up this market, it's going to be that 10-year Treasury. So the things I'm starting to pay a lot more attention to, and I think the market will as well, is CPI and inflation numbers. I think those are going to be much stronger drivers of the market than they've been in the past. They're going to be much bigger indicators because people are really watching that Fed paper. And, if we get a violent move in the 10-year Treasury, the 10-year VIX, VXTYN explodes, that's where you'll see the Russell and the VIX explode. And On top of that, VIX right now, short VIX futures is a very crowded trade. You can see all those indexes get taken way higher on a short vol, short squeeze if something causes those to move. So that is what I'm watching, maybe not for this week, but for 2014.
Yeah, it'll be interesting. Of course, we didn't have a chance. You mentioned the 10-year. We didn't get to the other side of the spectrum, which is, of course, the new short-duration VIX products that they launched or announced recently. So a lot of stuff to dive into in upcoming episodes and how that stuff is going to impact the options, impact the term structure of the futures, getting into some of the term structure of the futures and the trading activity we're seeing going on in the Russell futures as well. Of course, a lot of things to get to in coming episodes, but unfortunately, that's all the time we have for this episode of Volatility Views. I want to, of course, thank both of my cohorts, my partners in crime, for joining me on the show. Mark Sebastian had to run, so if you want to check out what he has cooking, then serve on over to optionpit.com or, of course, Swan Wealth Advisors, where they have a lot of great info on what they're working on over there as well. And before we go, Pat, why don't you give our listeners, I know we've been kind of touching on it throughout the episode, but give our listeners a little bit of a tease of perhaps what they can expect in the coming weeks and months out of the Russell options camp.
I think it's going to be an exciting year here at Russell Indexes, and we're looking at a wide range of potential derivative products. We certainly are looking in the U.S. at retail investors, and as you know, the Russell 2000 it has a heavy-duty institutional component. The IWM answers the need for many retail investors, but we're kind of looking at some indexes that retail investors might be interested in trading, cash settled indexes rather than an ETF option. And then globally, we're looking at some things in Europe. We just launched a UK mid 150, and we have a SMID 300. Our specialty being small cap indices, and we're looking at how do we leverage that expertise globally. So it's going to be an exciting year here at Russell Indexes.
Of course, those are all exciting things to us. We love talking about RVX, but we really love working with partners who are taking a deep dive and exploring all of their options, pun intended, when it comes to the options market. So we're looking forward to discussing all of that fun stuff in upcoming episodes of Volatility Views as well. And, of course, if you'd like to make your voice heard on Volatility Views and join us in the Volatility voicemail, a lot of great ways for you to do that. Of course, you can surf on over to theoptionsinsider.com, leave a comment on the show notes of this episode or indeed anywhere else on the site. We'll find it. We'll route it to the appropriate show and maybe discuss it here on the show. Of course, you can try our new, or should say revamped, Volatility voicemail number, 773-669-4VOL. That's 4865. Leave us a voicemail. We'll hear how you sound. It's kind of nice and refreshing to hear your actual voice as opposed to just all of the various ways you guys write into us. Of course, you can still do that. Send us an email, questions@theoptionsinsider.com. Just be sure to put question for Volatility Views in the subject line so we know to route it to the appropriate show. Or find us on Twitter, twitter.com/options, or on Facebook, facebook.com/theoptionsinsider. A lot of great ways for you guys to get in touch with us here on the Volatility Views program. And on behalf of Mark and Pat and, of course, myself, I want to thank all of you guys for staying so supportive of the show, even during the hiatus, and for being so excited for it coming back. We're very excited to finally bring it back, and we're looking forward to future episodes of Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.